Capitulation was the name of the game yesterday as markets sold off, but are we near a bottom? That's coming up on 3 Minutes on Markets and Money. Over the last few days, we've actually been talking about the market being deeply oversold, sentiment very negative. In fact, that is our article that's on our website today at realinvestmentadvice.com that, well, sentiment is so bearish, it's now bullish. That's typically where we see market bottoms at least form on a short-term basis. And I want to be careful with this because I'm not telling you that we're about to set a major market bottom and we're about to resume a new bull market. Not saying that at all, but what I am cautioning on is being careful not to throw in the towel and start to sell everything because, well, you're concerned the markets are going to crash and markets are going to go dramatically lower very quickly. Yesterday, of course, it certainly felt that way as markets did sell off very sharply all day long. And in fact, from a retail speculation standpoint, it was one of the top 5 leading sell-off days for retail investors that we've seen in recent history. I've got a little bit longer chart this morning on the SPY. This is the S&P 500 ETF because we can trade that. And I wanted to show you a couple of positions where we have been in this situation before, and it's actually been a decent trading opportunity. We are currently 3 standard deviations well below the mean right now. In fact, the S&P is trading 11% below the 200-day moving average. That's a very extreme deviation. Last year, we were talking about the S&P trading 12% above the S&P, and again that a correction would eventually recur from that, and that's exactly what's happened. But if we go back and look at previous periods where we've been this oversold into 3 standard deviation territory, each one of those periods led to a reflexive rally of some sort, even though that they eventually failed during this recent decline and went to lower lows. That's exactly what we could see here is a reflexive rally to a lower low, which would probably intersect with the 50-day, 200-day moving average where we are right now, and then potentially retrace to a new low. That would be an expectation of kind of where the markets are set up currently, as well as with the Fed continuing to hike rates. But you need some type of catalyst here to help create that bullish bias. What could that be? Well, maybe a little bit softer reading on inflation tomorrow that might give the markets a little bit of hope that maybe the Fed won't be as hawkish on hiking interest rates. Or it could just simply be that we start to get enough of a move that a lot of the short covering that's been in the market has to start to cover, and that helps lift stock prices higher. The point here is that with markets this oversold on multiple levels, that we're probably going to get some type of reflexive action, and trying to panic sell the markets is likely not going to work out well. But there are some risk here. I don't want to say that we're going to have absolutely for sure this reflexive rally and you're going to have a much better opportunity to sell into it. Things could go south from here, and there is certainly risk of that. We don't see it very often. In fact, we have to go back to March of 2020 for the most recent observation of that, where markets just kept going down and got into 3, 4, and 5 standard deviation territory. That can happen, but you typically need some type of economic exogenous event that basically breaks the markets in terms of a credit movement or money flows that leads to that very sharp sell-off. We don't have that in the markets just yet. Doesn't mean we won't, but very likely the odds are, and again, we're talking about odds and statistics, the odds are some type of reflexive rally, maybe not a lot, but use that to sell into to reduce your risk. If this market has really been weighing on you here over the last few months and you just want to kind of get out of the market, use a rally to do that. Try not to sell here at the lows, because when that happens, you typically then start to try to reverse your action because now you want to try to get back to even, so you start jumping back in the markets at exactly at the wrong time and you exacerbate the problem. Use a rally to sell into that, raise your cash levels, reduce your risk accordingly, and then be patient. There will be an opportunity to put money back to work. It may be at a higher level than we are today, but that's okay. It'll be a better opportunity to put back money to work when you're more confident that you can keep your investments in place for a little bit longer period. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you tomorrow.